Solved problems. Manufacturing budget. Problem. PEL company produces farm equipment at several plants. The business is seasonal and cyclical in nature. The company has attempted to use budgeting for planning and controlling activities, but in the variable nature of the business has caused some company officials to be skeptical for its usefulness. The chief accountant for the Adrian plant has been using a flexible budget to help plant management control operations. The president asks for an explanation of flexible budgeting, its application, and its possible use for the entire company. The chief accountant presents the following data. Budget data for 2014. Normal monthly capacity of the plant in direct labor hour 10,000 hours. Material cost 6 LBs at the rate of 1.5 rupees, rupees 9 per unit. Labor cost 2 hours at rupees 6, rupees 12 per unit. Estimated factory overhead at a normal monthly capacity. Variable factory overhead. Indirect labor rupees 6,700. Indirect material 500. Repairs 700. Total variable factory overhead 7,900. Fixed factory overhead. Depreciation 2,500. Supervision 3,500. Total fixed factory overhead 6,000. Total fixed and variable factory overhead 13,900. Plant units for January 4,200. Planned units for February 5,500. Actual data for January: hours worked 8,500. Units produced 3,900. Costs incurred: materials 24,000 LBs, rupees 34,000. Direct labor 50,000. Indirect labor 5,000. Indirect material 600. Repairs 1,800. Depreciation 2,500. Supervision 3,500. Total 97,400. Required: a manufacturing budget for January. B. A report for January comparing actual and budgeted costs for the month's actual activity, assuming that the units produced are to be measured of activity used in preparing the flexible budget. Budget. Plant capacity budget. Capacity in hours 10,000. Material cost 6 LBs at 1.50, 9 rupees per unit. Labor cost 2 hours at the rate of 6, 12 rupees per unit. Direct material 10,000 into 9, 90,000. Direct labor 10,000 into 12, 120,000. Total prime cost 210,000. Variable factory overhead. Indirect labor 6,700. Indirect material 500. Repairs 700. Total factory overhead 7,900. Fixed factory overhead. Depreciation 2,500. Supervision 3,500. Total fixed factory overhead 6,000. Total cost A plus B plus C 223,900. Manufacturing budget for January 3,900 units. Material cost per unit 9 as per budget. Labor cost 12 rupees as per budget. So direct material 3,900 into 9, 35,100. Direct labor 3,900 into 12, 46,800. Total prime cost 81,900. Indirect labor 6,700 by 10,000 into 3,900, 2,613. Indirect material 500 by 10,000 into 3,900, 195 rupees. Repairs 700 by 10,000 into 3,900, 273 rupees. Total factory overhead 3,081. Fixed factory overhead. Depreciation 2,500. Supervision 3,500. Total fixed factory overhead 6,000. Total cost 90,981 as per budget for the month of January. Manufacturing cost actual for the month of January: 3,900 units are produced and material cost incurred 34,000, direct labor 50,000, total prime cost 84,000. Variable factory overhead, indirect labor 5,000, indirect material 600, repairs 1,800, total factory overhead 7,400, fixed factory overhead, depreciation 2,500, supervision 3,500, total fixed factory overhead is equal to 6,000, total cost is equal to 97,400. Variance, favorable variance in the case of direct material, unfavorable variance in the case of direct labor. Direct material, favorable variance 1,100, direct labor, unfavorable variance 3,200, total prime cost variance is equal to 2,100 unfavorable. In the case of indirect labor, unfavorable variance 2,387, in indirect material, unfavorable variance 405, repairs, unfavorable variance 1,527, total unfavorable variance is equal to 6,419. Remarks, reasons for the variance. In the case of direct material, the favorable variance is due to less direct material used than budgeted. In the case of direct labor, the unfavorable variance is due to excess direct labor used than budget. In the case of indirect labor, the unfavorable variance is due to increase in actual indirect labor expense. Indirect material, the unfavorable variance is due to increase in actual indirect material used. Repairs, the unfavorable variance is due to increase in repairs incurred than budgeted. Recap. Thanks for watching. Please subscribe to our YouTube channel Accounts Lobby for various solved problems and lectures on accountancy.